Futures in Chicago. All right, Oliver, looks a little bit more buoyant when it comes to the wheat, but the others are kind of struggling a tad.
Yeah, the wheat market was under heavy pressure early this morning. We got the third consecutive trading day of cancellations from China, and the market has responded with buying. It's one of those old things where you trade the rumor and fade the headline, and we're certainly seeing that play out in the wheat market. So hopefully that's a sign that we kind of purge the bad news and can get a relief rally from here. And I think the same can be said really for corn and soybeans over the last week, where last week's report just wasn't enough to offer new bearish news to the market that we triggered a little bit of short covering. And I think some of that was probably technical and seasonal in nature. Everyone was watching the 20-day moving average, and it seems so simple, but it becomes self-fulfilling if enough people watch it. We got out above there, got a good close for corn and soybeans last week, the second consecutive week of gains, which hasn't been done for several months. So nice to see the grains get some momentum here into the spring season, because gosh knows we need it. It's been a difficult several months, especially for that soybean market. Funds were net sellers for 16 straight weeks, and that is just unprecedented.
It is, and when we didn't get anything new, we didn't get any new bearish news on Friday, so we didn't attract any new sellers. I felt as though that the playbook was pretty wide open for the bulls. If they wanted to run it, they could have. They didn't take it as far as I think they could have, but it's probably good that they didn't, because now that they were in charge on Friday, they need something to come in and support them on Monday, and we haven't seen that really. That's why I think we're kind of languishing. What do you think about that?
Yeah, I'm just happy to see the markets trading back and forth a little bit instead of the slow bleed lower. I think, as I'd mentioned, during the springtime of year, you start to get the jockeying back and forth. I do think that we can probably get a little bit of more of a relief rally out of here, maybe get that May bean contract up near $12. But I think fundamentally speaking, on a longer term horizon, I think it's going to be difficult to have anything really sustainable. So I think if we do get continued relief in the soybean market in particular, I think producers ought to be looking at opportunities to at least raise the floor a little bit, especially if they miss some opportunities at the end of last year.
Yeah, I mean, that was going to be my question. You probably, maybe not reward with sales, but just make sure you've got some put spot underneath, right?
Yeah, absolutely. And volatility is creeping up, where I think we're at about 6-month highs for corn and soybeans, but seasonally we continue to see volatility pick up from here. So I think volatility continues to get more expensive. So if that's true, it's relatively cheap right now, and put options are a great way to keep your upside open while minimizing that downside risk on your physical grain.
All right, stay right there. We're going to go away. We're going to pay some bills. We're going to come back and talk more with Oliver Slope. He's with Blue Line Futures up in Chicago. We're going to be right back after this. Our guest analyst, he's Oliver Slope, Blue Line Futures, and they just gave me the 60-second timing in my ear, so let us have it for a whole minute.
All right. Well, the cattle market's what we're keeping a close eye on. Both live cattle and feeder cattle have had a heck of a run here, really since the start of the year. But you can see on the chart, it's starting to look relatively tired, especially for the feeder cattle market. And as we've mentioned in the grain segment, if we do see a little bit of relief come into the market and grains, I think that's going to be a headwind for feeder cattle. And with that said, I'm looking for live cattle to outperform. We know the cash market continues to tick up. I think the 5-area average on Friday afternoon was 185, so still holding strong. As long as the outside markets don't fall apart, I think that cash trade will continue to grind higher, and we can outperform feeders. Lean hogs, that's a different story. I think we probably got a little bit overdone. I think there's probably a little bit more downside here in the near future.
And cattle, you want to keep bringing your floor up with you real quick? Does that still look a good idea? No?
Absolutely. Again, especially at the end of last year, if you were saying, man, I wish I would have laid off some risk in the mid-180s, this is a great opportunity for you.
100%. Awesome stuff. I totally agree. All right. Thank you very much. That's Oliver Slope. He's with Blue Line Futures up in Chicago. Bring it back down here to you, Suzanne, and Music Row.
Thank you so much, Scott. Well, a 3-day boot camp in Arkansas.